So this is chapter 13, which is about budgetary control responsibility accounting. The course is the same, accounting 621, accounting for managers. Now, before I start the lecture, I want to tell you something, and I want it to be on the recording. Besides the budgetary and everything, now I want you to do some budgeting by yourself. In terms of, I want you to go back and check all your discussions, the discussions that you have to complete. If you miss any of the discussions, please complete it.
Recording in progress.
By next Tuesday, you should be done by all the discussions. Now, that will help me to give you those 5 additional marks. 5% of your score is going to come based on your discussions. I'm not going to check the quality of the discussions. I'm not going to chase for spelling mistakes and anything like that. I just want to see posting from every each of you. That's easy marks, so make sure you get it. Missing discussions is going to cost you 0.5 marks. So 2 missing discussions, 1%. So that's easy 5%. Make sure you get it. The other thing is for the quiz 3, for the last quiz, which is not this Thursday, next Thursday, and that will be our last meeting. And that's the only thing that you have to do, the quiz 3. For that quiz gives you 15% of the marks. That quiz we're going to talk more about, I'm going to talk more about on Thursday and next Tuesday. That's 15 and 5, that's 20 marks. And then you have another 25 marks on your case, group submission. On the group case, again, I'm gonna give you some, try to give you some brief, again, explanation on Thursday, for each group, what is expected and which areas you have to cover. I hope you already identified the areas, but I'm gonna go over those areas just in case, so you make sure you understand everything. Now there's another 5% that's sitting for you, which are for your self evaluation. On the self evaluation, please try to be fair to yourself. Be like Japanese people. Okay, and so that's 5 evaluation, 5 discussion, 10, 15 on the quiz 3, 25, and 25 on the final case and the presentation. That's 50%. So half of the marks on this course is gonna come in the last week. So make sure you get as much as you can. Some of you need it, some of you not so much, but you decide what to do. Now, that being said, let's go back to our lecture and go with the budgeting, with the actual budgeting and budgetary control and responsibility. Now, we learn what the budget is. Budget is quantitative plan of the resources, financial and non-financial, from where we're going to acquire them and how we're going to use them. The budget is prepared for the period of 1 year. Usually it can be start always with 0 every year, or can be running budget. That means every time when the 1 month expires, we're going to add the same month at the end, and we're always going to have 12 months budget. Now, once we have the budget, then we come to the budgetary control. Remember, the budget helps us only and only to help us to reach our goal. If we don't have a goal, there's no reason to have a budget. If we don't have a goal, there's no reason to have a budgetary control. Why? If we don't want to achieve anything, there's no reason we to make a plan how to achieve it. And the control is irrelevant. But let's pretend the company that we're looking here has a goal. They prepared the budget, and now let's see what the budgetary control is about. That will be the management function, which is one of the important functions in the company. Budget reports which is the component of this function. So what we're going to do, we're going to use the budget that we already prepared, and we're going to compare the budget with the actual results. And that's going to give us a feedback, and we can understand and analyze how the company performed on the current stage based on where we're supposed to be. Based on the report results, we're going to analyze the differences between the where we are versus where we're supposed to be. And then we're going to start determining the differences and the causes for those differences. Then we can decide and determine, do we have to take corrective action, or we should keep going doing what we're doing? And if the budget needs to be adjusted, we're going to adjust the budget, but the following periods. So how this going to work? The budgetary control. We're going to prepare the reports. First, we're going to set up the goals. We're going to identify what we want to achieve. Then we're going to develop this budget. Budget, again, is a plan, quantitative plan of from where we're going to get and how we're going to use the resources. When the period starts, when we already have the plan, we're going to start comparing where we are versus where we're supposed to be in order to achieve our goal. We're going to identify the differences, we're going to analyze the differences, and we're going to take a corrective action. Once we take corrective action, we're going to make a new plans and keep going the same circle. Budgetary controlling works the best when the company has harmonized a reporting system, which is identify the name of the budget reports, states the frequency of the reports, how often the reports are prepared, weekly or monthly or quarterly, specify the purpose of the reports, and indicates who is the person who's receiving those reports. This schedule obviously is going to give you some ideas of all these functions which are part of the budgetary control. For example, the sales report, as we can see, the name of the report is sales. That is produced weekly, and that's determined where the sales goals are met. And that will be only for the top manager and the sales managers. Labor will be weekly report again. If we're paying our employees on hourly basis, that will be weekly control, and that will control the direct and indirect labor cost. That will be the vice president of production, most likely. It has nothing to do with the human resource. Scrap, which is a daily report, is going to determine our efficiency, how we use the materials. And that will be directly for the production manager. The top managers, they don't need to see this. Departmental overhead cost, that would be monthly, and you can see the name of the report, frequency, the purpose of the report, and the person who is responsible or receiving that report. For the budget, we're going to have one static budget, which we prepared last time. Why static? Because that budget is applicable only and only for the level of sales that we identify before we start the report. If we don't achieve that level of sales, in reality, the budget that we prepare, we cannot compare it with the actual situation. So what do we need? We need a master budget, obviously, but the master budget, we can ignore the data about the different level of activities. So let's pretend that we're having this selected information for the static budget of this company on the first quarter, second quarter, for the half year. This, as you can see, first and second quarter, we budget the first quarter sales to be 180, the actual sales 179. We have a difference. Second quarter budget 210, actual 199.50. Another difference. So on the first two quarters, we have a difference of $11,000. Now the sales budget for the first quarter, if we take a look, budget versus actual, we have 1,000 unfavorable variance. What's happened now? Our sales haven't reached what we budgeted. The variance unfavorable means in the sales, that means our sales are less than what we projected. Variance is considered to be unfavorable if the difference between the actual budget reduces the operating income. So every time when we see the decrease in operating income, that's unfavorable. Now, for the sales, if the actual is less than the budget, that reduces the income. But if you take a look the same thing and apply to the expenses, actually works opposite. Why? Because we're deducting the expenses from the sales in order to get the income. So what that means, if the budget expenses are less than the actual, that means our income is going down. So that's unfavorable. In other words, if the actual expenses are higher than the budget, which is equal to the budget's expenses are less than the actual, right? Just different explanation. If the actual expenses are greater than the budget, then that's unfavorable. So we can see for the sales is the opposite. We have to be careful here. When the sales, actual sales are less than the budget, that's unfavorable. For the expenses, if the expenses are more, actual expenses are higher than the budget, that's also unfavorable. On the favorable variances is the one that drives the operating income higher, which are if the actual sales are higher than the budget, then we have favorable. For the cost, if the actual cost is less than the budget, then it's favorable. If we're supposed to spend 1,000 but we're spending 500, that's favorable. Okay, having this in mind, let's start with the examples here. Let's determine the variances of the, so we can identify what's the costs and benefits for this. First, we still want to start with the sales. Again, the budget is 180, the actual 179. As you can see, the sales going down than the budget, that drives unfavorable variance for the first quarter. For the second quarter, if we take a look again the sales budgets, we're gonna see for the sales budget production line, actually, we have a report shows the sales second quarter, which were 10,900 below the budget or 5% below the budget. So our second quarter budget was for 210 sales. The actual sales are 199,500, which drives 10,500 unfavorable variance on sales. Now the uses and the limitation for what we're going to use the static budget. The static budget is not very useful. Why? Because if we are only, it's applicable to sales to show us where are the sales. What's actually happened with the sales? Are we high or low for where we projected or where we budget to be? So the actual level of activity, that's a closely approximate the master budget activity and behavior. The cost of the fix is in response to the change of activity. So what we have to do is we have to understand again, in order to make it effective, we have to understand that the starting budget is appropriate for the fixed costs and the sales administrative expenses. It will be very difficult to evaluate performance on the variable cost. Why? Because the variable cost changes with the level of activity, where the fixed cost remain regardless of the level of activity. So for that reason, if something small, if we have change on the actual versus the budget, which doesn't meet exactly what we budget, it will be very hard to understand why the variable costs are changing. Where the fixed cost, since it's fixed cost, the level of sales, it doesn't change. So let's see one question here. What's the limitation of the static budget? The limitation here will be that the static budget is only prepared for the one level of activity. So if we don't reach that level of activity, we cannot make a logical analysis and make a logical conclusions of what drives those variances. So the logical answer here will be C. So let's prepare the following practical static budget. Which of the following correct regarding the variances? Sales and fixed manufacturing costs are both unfavorable or favorable. Let me grab this question, the entire question, and let's move it to the Excel spreadsheet and let's do it together and see what is happening here. Actually, we have the difference. We don't need to go to Excel. Hold on a second. I don't need to open this Excel spreadsheet. I can keep it open, but let's see now. Sales, what's happened with the sales? Sales are higher. Actual is higher than the budget. Is that favorable or unfavorable for us? What do you think? If the sales are actually higher than the budget, is this favorable or unfavorable? Tell me something in the chat room. It's a favorable, yes. So we're chasing answer where the sales are favorable, right? Every time when you see sales unfavorable, so that means that's incorrect. And sales are unfavorable, that's incorrect. So we are now 50-50 between those two. Fixed manufacturing cost, we expect to be 109, but the actual 155. So the costs are higher than what we expected. Is that favorable or unfavorable? That's unfavorable. So we're chasing the answer where the fixed costs are unfavorable. Well, as far as I see, this is the only options that they have where the sales are favorable and fixed manufacturing costs are unfavorable. Right? Let's see what's the fixed sales administrative expenses. We expect to be 310. In fact, they're 295. They're low. Actually, is lower than the budget. Is that favorable or unfavorable? It's a favorable. So which one will be the correct answer? C. Make sense? Flexible budget. Now, I already told you that the static budget is good as only for the identifying where the sales are versus the budget actual sales and where are the fixed costs versus the static budget. But that's all. Nothing more, nothing less. But that doesn't help us to understand where we are and what we're doing. So for that reason, since the static budget is only prepared for one level of activity, we're going to prepare another budget, which is called flexible budget. The flexible budget is going to provide using the same budget data, same budget logic, but on the various level of activities. Or we're going to have a series of different level of activities. When we're preparing the flexible budget, we know that variable cost per unit stays the same. Variable cost in total change with the level of activity. Fixed cost is fixed, regardless of the level of activity. And we're going to start preparing this. So now let's see what this report. On this report, what we can see is that we projected our budget to be for 10,000 units. If we produce here 10,000 units, that will be our cost. But in reality, we produce 12,000 units. Now, if we're producing more, most likely all the cost which is related to the level of activity will be higher. And all the fixed cost, which doesn't matter of the level of activity, it most likely will not have any differences if we keep the cost the same. So as you can see in this report, we can identify that the indirect material cost went up with $45,000, indirect labor costs went up with $52,000 and utilities went up with $35,000. But we don't know why they went up. Is it because we changed the level of activity or because the cost of the indirect material went up? That will be hard to explain at this level. For that reason, what we have to do is, once we know which cost is variable and which cost is fixed, we have to prepare the flexible budget. How are we going to do this? First, again, we're going to identify and we're going to separate the fixed cost from the variable cost. The way I see it here, the variable cost is indirect material, indirect labor, and utilities. Actually, utility, they might be a fixed cost, but we're going to see how they drive the cost. So, for the variable cost, what we know is that variable cost per unit stays the same. So we have here indirect material cost 250 because we produce 10,000 units. Now the question is, how much per unit? Well, once we remove the zeros, we can easily identify. That will be 25 for indirect material, 26 for indirect labor, and 90 for the utilities. Once we know that, then we can prepare another budget which is matching the actual level of activity. So first thing first, we're going to identify and separate the variable cost from the fixed cost. Once we do that, then we gonna get the variable cost per unit, as we're doing here. Indirect material, 25 per unit. Indirect labor, 26 per unit. And utilities, 19 per unit. And we're gonna apply those one to our actual level of activity, which is 12,000. So if we have 12,000 and the variable cost for the indirect material is $25, our budget cost would be $300,000. In reality, our actual cost is $295,000. So we cost is $5,000 less, which is favorable for us. Indirect labor, we expected cost was all budgeted 312, which we achieved in the actual. And the last one is the utilities. We budgeted for 228, where the actual cost is 225, which give us a $3,000 reduction of the cost, which is as well favorable. So in overall, we have a favorable variance. Now, if we take a look on the based on the static budget, which is from the level which is completely different, when we compare the static versus actual on the $10,000, we're seeing that we have $132,000 unfavorable variance, which is not the reality. The reality in reality is we are actually saving $8,000. So the fixed cost, those are the same as the budget. So we don't have to do any changes on the fixed cost because again, fixed costs are fixed costs. The variable cost, however, we have to be careful because the variable cost per unit, as we already know, they do not change. How are we going to develop this flexible budget? First, we're going to identify the activity index and the relevant range of the activity. Second, we're going to identify the variable and split the cost between the variable and the fixed. For the variable cost, we're going to identify the cost per unit. For the fixed cost, we're going to keep it at total. When we do that, then we're going to prepare the budget for the selected new level of activity, and we're going to run the report again. So for this company, manufacturing overhead cost comparison for the finishing department of 2022 master static budget. Now the expected operating capacity is 120,000 direct labor hours. Operating costs are variable cost and fixed cost, as we can see. Now, once we have this information, we're gonna have to come up with the variable cost per unit, simply dividing by cost by the level of activity where we are, 12,000 direct labor hours. And we're gonna count that indirect materials is $1.50. Indirect labor is $2 and utilities are 50 cents. So the relevant range for this company is where the cost behave as variable and fixed as fixed is between 8,000 and 12,000 units. Next thing, we're going to identify the fixed costs, which are fixed costs are given to us, depreciation, supervision, and property taxes. Those are our fixed costs. And then we're going to prepare the budget for the selected increment. Now let's prepare for the increment from 8,000, 9,000, 10,000, 11,000, 12,000. That's what it's gonna do. And that's exactly what they're doing. Having in mind that depreciation, where is that? Depreciation, this is the depreciation for the entire 2022 is 180,000 divided by 12. We're gonna get it per month because here we're preparing the budget per month. Supervision 120 divided by 12 and property taxes 60,000 divided by 12. Once we do that, then we can prepare the following budget, monthly budget. Now we're going with the monthly budget. On the monthly budget, we're going to prepare for different level of activity for 8,000, 9,000, 10,000, 11,000, and 12,000, which is our relevant range between 8 to 12. As you can see, fixed cost stays the same. Variable costs are the one that's changing. Why? Because for the different level of activity, we have to add additional cost per unit since the unit is changing with 1,000. And on every level, as you can see, the indirect material cost changes with 1,000 units, $15,000 change. For the indirect labor, 1,000 units, $2,000 change. For the utilities, for 1,000 units, $500 change. And once we have this budget, the fixed cost obviously is going to remain the same. And then we can prepare our graph. We know the fixed cost per month. And the variable cost is the one that fluctuates based on the level of activities. And since we're going to highlight the two levels between 10,000 and 12,000, at level of 10,000, we have total cost of 70,000, as you can see. Level of 12,000, we have 78. Level of 8,000, we have 62. So basically, this chart here should reflect exactly that information. Now let's review this. When we're developing the flexible budget, management should take the following steps, which is the following steps that management has to take. Yuichiro is right. Most likely will be all of that. But let's confirm this. Yes, it is all of it. Let's do something now. This company has a budget fixed manufacturing overhead cost of $100,000 and per unit variable cost of $3.50 for the direct material, $8.95 for direct labor, $4.10 for the variable overhead. What's the relevant with the relevant range between 10,000 and 15,000 units? What are the total costs for activity level of 10,000 and 14,000 respectively? So now I can use the Excel spreadsheet. And I'm gonna flip this and gonna open the Excel spreadsheet and gonna share it with you. If I forget to share it, please remind me so I can share it. I believe you should be able to see it. So this is our question. What we have to do is we have to simply prepare the budget with a different level of activity. Now, one activity will be for 10,000 units. The other will be, I can go 11, 12, 13, 14, 15. Let's go 11, 1, 2, 3, 12, 1, 2, 3. And let's keep this pattern, and that should be 15 here. 13, 14, 14,000 is the last level of activity that we want. Okay, I get my starting point. Let's put it this way. That's a number of units. Okay, so what I need the different costs. That's my level of activity. And then I'm going to add the costs. First, I have variable cost for direct material. And my direct material is variable cost for direct material is, as you can see, is 3,050, $3.50. Then I have direct labor, which direct labor is $8.95. And then I have variable overhead, which the variable overhead is $4.10. So once I have this information, for me, it's very easy to prepare this one. So first what I have to do is 350, which I'm gonna log, time 10,000. Sorry, 350 log time 10,000. And then I'm gonna move it all the way to the end. And this is my direct material for all the level of activities. Then I'm gonna have equal to 8.95 log the sales time 10,000. And then I'm gonna have equal here 410 log the sales time 10,000. Once I have those calculations here, I can easily see what's my total variable cost. And my total variable cost is gonna be all those totals here, 160,500 and done, done. So the question is, what's the hour total cost? So the other thing that we have is that fixed manufacturing overhead cost is $100,000. That's the fixed cost is $100,000 regardless of the level of activity. That's too many zeros, 1, 2, 3. And I can easily copy and paste this one. So my total cost, it will be on different level, and the level of activity that I'm chasing is 10,000 and 14,000. So this is my first level of activity that I want to know the cost. And this is my second level of activity that I want to know the cost. So that should be give me the combination of the numbers that they have for these two costs, which is this one, and this one is the logical answer, should be. Do you see answer that have those two numbers which are highlighted? Yeah, that one should be letter C answer. Let's see if that's the case. And that should be the correct answer. And that is the correct answer. So again, we're going to have two sections here, production data and the cost data for the variable and fixed cost. And those widely used production and service department evaluate the manager performance in the production and the cost control. So that's why we need those flexible budget reports. So once we have the flexible budget report, I can start identifying what's the variances for the variable costs, what's the variances for the fixed costs, which one is favorable, which one is not favorable. Both of favorable, regardless is it favorable or not favorable, should be bring to attention to the managers and identify what's the reason for that. Now, for the responsibility accounting concept involve the accumulating and report the cost on the basis of the management who has the authority to make the decisions. So the management's performance also is evaluated of the based on the actual results and how the actual results is compared to the budget that we already set up or the plan that we already have. Responsibility accounting using is useful for each level of management as long as the following exists. First, the cost and the revenue can be directly associated with the specific level of the management responsibility. Cost and the revenue are controllable by the manager, and the budget data can be developed for evaluating the management effectiveness of controlling the cost or the revenue. Now, responsibility accounting is especially valuable when we have a decentralizing system where the power to the people to make decisions is spread across the company. So for that reason, we need some tool to control their performances, and responsibility accounting concepts comes handy. The key differences between the responsibility accounting and budget reporting is that responsibility accounting distinguish controllable and non-controllable cost, where the budget focus on the fixed and the variable. So for that reason, we're going to split the cost between controllable and non-controllable costs, and applies for both profit and non-for-profit organizations or entities, where the profit will be the basic goal will be to maximize the net income, where the non-for-profit is to minimize the cost and provide more services to the people who are depending on that non-for-profit. That brings us to the two categories of costs. One cost that we can control and the other cost that we cannot control. Controllable cost will happen directly by the responsibility level of activity and are controllable up to that level. So basically, the cost is happening only and only because we have that level and we can control that level. Non-controllable cost will be the cost which is indirectly incurred and allocated to the responsibility level, where the management has no decision over the allocation. Responsibility accounting needs performance evaluation to be fully effective, and the performance evaluation needs responsibility accounting to be fully effective. So both depends on each other. Performance report should contain only the data, again, information which is controllable by the responsibility centers. Anything that is not controllable by the responsibility center should be eliminated. Has to provide accurate and reliable budget data and highlight significant differences between the actual and the budget. Which is the principal performance evaluation? Management is a review of the budget. When we review the management based on the budget, then we're going to focus on the difference between the actual and what we perform, expecting to happen. Now we're going to investigate the material differences and the differences which are controllable. So if the manager can control the cost, yes, we're going to investigate it. If the manager cannot control the cost, that's not going to be part of our investigation. The other thing is that only the amounts which are material means that's going to change our decision or our perspective is going to be reviewed. Management responsibility centers. We're going to create a management responsibility centers which will directly involve for the setting the budget goals. Performance evaluation should be based on the entity no matter that can be controlled by the manager. And the top manager should support the evaluation process. Now we're talking about here the evaluation, how we're going to evaluate the people, and of course, once we come to evaluation, how they're going to be rewarded. Performance report, once we prepare those performance reports, only the data which can be controlled by responsibility center, again, should be included in the report. Anything that the manager cannot control should not be included. That will provide accurate and reliable budget data and highlight the material differences between the budget and the actual. Then we're going to see what's the intended evaluation for that report. Is it for the performance? Is it for the bonuses? What exactly is the intended evaluation? And then we're going to prepare the reasonable intervals so we can prepare the report which actually fits our needs. On the responsibility accounting, reports will be prepared for each level of responsibility, beginning with the lowest level of responsibility and moving up to the top. That will help us to compare the evaluation, provide the incentive to the managers, and the factory manager can rank the department management effectiveness in controlling manufacturing cost if we have to do that. Now let's see how this is going to work. Let's see that on this specific example, as you're going to see, is we have the CFO or the El Presidento here sitting. Then we have the vice presidents of sales, vice president of production, vice president of finance. The information of our production facility, which are in Toronto, Montreal, and Halifax, since those are factory, goes directly to the vice president of production, which the vice president of production responds to the president. Now, those factory in Montreal, each factory, they have different personnel, but let's say take a look at the Montreal factory specifically. On Montreal specifically, what happened is the fabricating, assembling, and assembling are different processes which are part of the factory. So if there's anything in those departments, that will be reported to the factory. Factory, we're going to combine all the reports, going to report to the vice president. Vice president going to prepare the report for the production, and the president going to look at the report. That's how the report is prepared. Now, let's see how we're going to evaluate the performances. So let's pretend that the following report is prepared for the president. The president look that we have a budget of 150,000 for the controllable cost, and the actual cost 151,500, which on the president level, that's unfavorable. 1,500, that's not considered material. But when we take a look at the different vice presidents, we're seeing that the one that drives the highest unfavorable variance is the production. Once we see this, then we're going to start looking for the production. And we're going to try to identify why we have such a high unfavorable variance of $7,300 from the production. Now we're gonna bring the report to the three assembling factories, which is Toronto, Montreal, Halifax. We're gonna compare the budget with the actual in the both on those three factories, and we're gonna identify that now the 7,300 differences from the previous report that coming because we have all the three factories. So now we're gonna chase which is the factory that contribute the highest amount to that variance of 7,300, and we identifying that Montreal factory is the one that actually has a $5,300 unfavorable variance. Now we're gonna draw down to the Montreal factory. And the Montreal factory, we have the three processes: fabricating, enabling, and assembling. We're gonna take a look now. Both those three departments should bring the difference of $5,300, which in fact that's exactly what's happening. So once we have that one, then we're gonna start monitoring each of the costs for the fabricating, enabling, and assembling, and then we can identify which department under that factory actually we have to investigate further and find out why the difference exists. If we have to go one level deep on the once we say, okay, fabricating is, let's see what's happening in the fabricating. What they give us $1,300 unfavorable variance, then we can break in that fabricating department. We're going to see how much is direct labor, the direct material, direct labor, variable overhead. And each of those going to give us some variance. And as you can see that $1,000 unfavorable variance comes from the direct labor. So that's how we going from the top all the way to the bottom, which will be the single spending for each of the department on direct material, direct labor, and manufacturing overhead. So let's see responsibility center and how we're going to do this. Again, the report D typically report that go to the lowest responsibility level of management for the department management, which prepare fabricating, assembling, and enabling. Report C is the example of report that is sent to the next high level, which is factory manager. Report B will be report on the third level of responsibility showing controllable cost to the vice president, and the report A is typically the report that goes to the highest level of responsibility, which is the president. Now, what kind of responsibility centers we want to have in our corporate structure? We can have cost center, which is a manager for the cost center will be responsible only and only for the cost and expenses. Example will be production centers or service department. Then we may have a profit center. Profit center is the one who is responsible for revenue and the cost or expenses. So no decision can be made on that level for the capital investment or anything like that. So the example will be the individual retail store or a branch of any companies. And the last one, the highest top level, will be the investment center. The investment center is the one who is responsible for the revenue, expenses, and return on investment. Those are the ones that have a decision-making authority to invest, to purchase fixed asset, to dispose the fixed asset. That will be the head office of the company or subsidiary company. For the responsibility accounting for the cost centers will be managers of each of those centers will be based on what they can control and what they cannot control. So let's see now on the department management, if he can control all the manufacturing overhead costs except the depreciation, property taxes, and his own monthly salary. So those should be excluded from that report. So we can see that indirect material is give you the unfavorable variance of $500, and utilities give you another $100 unfavorable. So the indirect labor, we actually saving $1,000. So that's bring us total overall saving of $400 favorable. Based on that information, both controllable revenue and controllable cost can be used for evaluation of that responsibility center, and manager, which control operating revenue, such as sales, that will be including the things that price, quantity, customer management, control also the variable cost and expenses, which include the that sales center, profit center, which are driven by the sales for the variable cost and fixed cost and fixed cost. Direct fixed costs will be also called traceable cost, which are related only and only for the existing in this particular profit center. Those will be incurred for the sole benefits of the center, and those will be controlled by the profit center manager. Indirect fixed costs, those will be the company overhead or operating expenses for the company, which will be incurred on the benefit of more than one profit center. And in this case, the manager will not have no control over these costs whatsoever. So those costs technically should be evaluated. So when the profit center reports, when we prepare those profit center reports, we can only put the controllable cost. So, and then we can compare the actual revenue and cost with the budget revenue and cost, which can be controlled by the manager of that profit center. We can use the technique called cost volume profit analysis. And based on that, we can prepare the cost volume profit income statement, which will show us the sales, variable cost, contribution margin. Then we're going to have a controllable cost, which are controllable fixed cost, and then we're going to have controllable margin. So the cost which is not controllable will be eliminated and not reported on the report. So which of the following will not be a common cost for the responsibility center? So which of the following is not common form of the responsibility center? Remember, these responsibility centers are, let me bring them back to the screen. I believe they're here. We have 1, 2, 3. So the question is here, which one of those is not? And that will be C division center. That should be the correct answer. Yes, it is. And let's see another one. The following responsibility report was prepared for the profit center East-West. Which of the choices describe the effort in this report? To allocate the head office costs are included. B. Allocated head office management salary are included. Allocated office costs are included. Contribution margin is not. Allocated head office and manager salary are included. The contribution margin is not reported. So which one is the error here? First, sales, those are sales. Variable cost, that's fine. Variable cost, after we have a variable cost, we should have what we should have after the variable cost? We should have a calculation, correct? What will be our calculation? The calculation usually is going to be after the variable cost. We're going to have contribution margin. So the contribution margin is not included. Next thing, cost of goods sold. Okay, those are related to sales, fine. Controllable selling administrative expenses. Okay. Allocated head office cost. Now the question is the manager of this division has anything to do with the head office? And can he control that cost? Obviously, he won't be able to control that cost because that's a head office. He doesn't even, may not go to the head office at all. And the manager's salary, that manager's salary is again is controlled by, not by the manager, it's controlled by his superiors, which will be in the head office. So if we eliminate the head office cost and the manager's salary, and if we include here calculation for the contribution margin, we may have a very nice report. So the logical answer here, which of the choices describe the error in this report, will be letter D. Yes, that's correct. And that should be the logical choice. This is how we gonna evaluate the profit center. Again, the profit center will be used cost volume profit analysis, and we're gonna prepare the contribution format income statement, which has a contribution margin and controllable cost. So we can see which cost the manager can control, cannot control. The investment center is the interesting part, which the investment center making the decisions about the revenue, cost, expenses, and acquisition or disposal of the fixed asset. So the key performance indicator here is the return on investment. So how much you get for the money that you have invested. Now, let's pretend that return on investment is simply calculated of what you get versus what you invested. And if the controllable margin that we can control is $1 million, which is generating by the sales minus the variable cost, minus all the fixed cost, or the operating income in this case. But since it's on the level of the responsible centers, will be controllable margin from that responsible center divided by the average operating assets, which are part of this center. It's going to give us simple return on investment, which in this case is 20%. Now, there is major responsibility centers for such current assets and asset and accounts receivable, certain level of cash and the inventories. Exclude the non-operating assets, such as idle factory assets and land held for future use. That's what is included from the average operating asset. Base of average operating assets, and that will be once we say average operating assets, that will be the base average operating assets, which are the asset at the beginning of the year plus the asset of the end of the year divided by 2. Simple average. So let's see here, there should be some calculation. All the fixed costs are controllable. Average operating assets of this division are $2 million. And actual return on investment is less than the target or budgeted. So return on investment here is on the budgeted is 15%, but the actual is below the budget. In fact, the actual is 13.2% return on investment. How alternatively we can measure the return on investment? Then will be valuation of the operating assets. That will be value of the acquisition cost. So operating assets, since they're part of the formula and part of the denominator, they are kind of important because if we decrease the value of those assets, that's going to increase our return on investment. So for that reason, it's very important which value exactly is included on the calculation formula for the return on investment as a denominator. We have options for the acquisition cost, for the book value, for the market value, but whatever value is chosen should be used consistently from year to year. Income or the margin, that can be controllable margin or income from operation or net income. The best option obviously will be controllable margin because after that you have so many uncontrollable costs. So for the return on investment, we have to think how can I increase the return on investment and how can we reduce the return on investment. First, I can increase the return on investment when I increase the controllable margin, or I can improve the return on investment by reducing the operating assets. So for that reason, I can break the formula for return on investment into formula which is profit margin times the investment turnover. Once I divide the operating income divided by sales, that's a profit margin. Once I divide the sales over the operating assets, that's going to give me investment turnover. Let's see this here example. So now the sales are 2 million. Variable cost is 1,100,000 dollars. Contribution margin is 45% or $900,000. Controllable fixed cost is 300. Controllable margin is 600. Average operating assets are 5 million. 600 divided by 5 million is going to give us 12% return on investment for this case. Now, if we have to go and break it to the how can this manager improve the return on investment? First one is to increase the sales by 25%. If I increase the sales with 25%, that's going to give me increase in operating income. And my operating return on investment from 12% is going to jump to 15%. The second option is to decrease variable and fixed costs by 10%. If I do that, my operating income is going to go up. And that's going to help me to increase my return on investment from 12% to 15%. The other one option that I have is to reduce the operating assets by 20%. If I reduce the operating asset, that's also going to affect my formula. So instead of having $5,000 operating assets, I'm reducing it to $4 million operating assets, and that improved my return on investment back to 15% out of 12. Let's see one review here. Formula for calculating return on investment for the investment center. What do you think would be? We have two formulas, don't forget this. We have two formulas here. One formula is simply, let's see, what was the first formula? One formula is simply profit margin, or let me see, where is the operating assets margin measures alternative return on post here. Here's the formula. Controllable margin divided by the average operating assets is one way to calculate it. The other way to calculate it is operating income divided by sales and sales divided by operating assets. So having this in mind, what will be the correct answer here? D will be the right one because we have the both formulas. Here's the first formula, here's the second formula. If we have to do some calculation here, the newest division has reported return on investment 14% with the operating margin of 257.50. Target return on investment for the division was 16%. If the operating assets cannot be changed in the short term, what does the margin have to be in order to reach the target return on investment? So this question is interesting question. Obviously, this question will be what we're chasing here. What does the margin have to be in order? So operating margin. So the newest division has reported return on investment 14 with operating margin of 257.50. So if we go to the formula, the one that we have in here, and we go to the extended formula, which is here, we have the profit margin, we have the investment turnover. But in this case, we don't need that one. We need the control of the first formula, which is, let me find it somewhere, should be here hiding. Controllable margin divided by average operating assets equal to return on investments. Having this formula in mind, let's go and check our question. That's not gonna be the ideal pasting. Let me try another one. That's still not the same. That doesn't help me. So anyway, I have this controllable margin divided by average operating assets to give me 14%. So 250, 750 time divided by, sorry, that will be divided by something that I don't know, have to give me 14%, correct? So the question is, what's my denominator here? Can you solve it for the x? For the question mark? And what we're gonna get if we solve it for the question mark? Any help here? What's happened with the mathematicians in this course? Yes, the controllable margin, yes. 250, 750 divided by average operating assets or question mark, because I don't know average operating assets, should give me 40% return on investment. How much my average operating assets? That's what the question is. No. Before you answer anything, I don't need to answer B and C. I want number here. I want you to give me the average operating assets. So on the average operating assets, you're getting 1,791,071, correct? Is that what you're getting? 1.791071. Okay, that's a good thing. Now, watch this. Now, the question asks, if the operating asset cannot be changed, so I'm not changing this cell number, which is my operating assets here. I'm not changing this number. So the operating asset stays the same. 1,791,071. The target return on investment for the division was 16. Now I want to reach 16%. If the average operating asset cannot be changed in the short run, what does the margin have to be in order to reach return on investment? So how much I have to be here? How much should be my controllable margin in order to reach the 16%? And how much is it? So the right answer is C. So do you understand this question has two calculations? On the first calculation, you have to identify how much is the average operating asset. Once you get the average operating asset, then you can calculate how much should be the margin, the contribution or the operating margin in order to achieve the 16% return of the investment with the assets that you already have. Make sense? And for that reason, the correct answer is C. The B is the correct answer for the that is equal to average operating asset. Nothing more. But that's not what we're looking for. We're looking for the margin or controllable margin in this case. Sorry, the return on investment with operating margin. Yes, the operating margin is done. For the pending sales residual income, I don't think I'm gonna chase you on the residual income. I'm gonna take a look at the quiz, and if I need to chase you for the residual income, I'm gonna give you the residual income. But the residual income, just briefly to explain for the residual income, is return on investment has a disadvantage. Let's quickly go over this. It has a disadvantage which ignores the minimum required rate of return. So for that reason, we're going to incorporate one new performance evaluator for the investment center, which is called residual income. Residual income actually is going to tell you what's the difference between the actual income and the income that you want based on your expected rate of return. For example, let's say our controllable margin is $1 million. Assets are $5 million. Our return on investment is 20%. Now, to produce the product, operating assets is going to increase to 2 million. Now, if this happens, this company expects to generate additional 260. So, what will be the logic here? Controllable margin is 1 million without the tracker. If we're adding the tracker, we're going to be 1,260,000. Average operating assets is going to jump from 5 million to 7 million. So if we do this, Now our return on investment, as you can see, dropped down from 20% to 18% by adding this company, or by adding this investment. For the disinvestment, we have to increase the operating assets with 2 million, which is going to give us 260 controllable margin. So our current 20% return on investment shrink down to 18%. If the manager is evaluated for the return on investment, and if he see that return on investment drop down from 20 to 18, he's going to reject this project. But if the company minimum rate of return that they want is 10%, then this company is going to accept this project, even though this project is currently below the 20%, which is the return on investment where they're currently generating. Why? Because the company itself wants only 10% return. And as long as any project gives me more than 10%, I'm going to accept it. So this is example how the person who is evaluated on return on investment can reject profitable projects which meeting the minimum required rate of the company. So for that reason, let's see what's the return on investment, residual income here. With my 10% that I want from the 2 million, I want $200,000. This project give me $260,000. So this project give me $60,000 residual income, or $60,000 more than what I want. For that reason, since the residual income is positive, I'm getting more than what I want, I'm going to accept the project. The residual income weakness is if we attempt to evaluate the company only to maximizing the residual income, that will ignore the fact of if that one division is substantially higher or has lower asset than the other. So for the different divisions, for the different size, we cannot use the residual income as a measure. I'm going to show you this in class so you can have a sense of this, and then we can talk about the last question here. For the last one, in order you to understand it and me to explain it better, I'll need the whiteboard so you can actually see, and you to come up with the idea how we can calculate and how we're going to evaluate those things. So once we finish those things that I want to do on the blackboard, on the board in the classroom, that will conclude our lecture, and that will be all for today's meeting. So thank you again for being here, and thank you for your participation.